Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, July 30th, and you're tuned in to On Trend. Thanks very much for joining us. So today we're going to look at the flag breakouts in IWM and MDY and revisit the regional bank ETFs, KRE and KBE, because they're very important to small caps. We're going to get selective on railroads, and there are two U.S. rails that I think stand out well as they break out. We're going to dissect the healthcare sector by looking at XLV and the key industry groups, as well as some key stocks. And finally, I'll finish with some stocks to watch. All right, so we'll start off with the S&P 500 SPDR SPY, and note that I am using unadjusted SPY. I've got a little hyphen or a little underscore, before the symbol. And so that takes out the dividend adjustments. And what that means is it looks pretty much like the S&P 500. The S&P 500 is my go-to index as far as the stock market is concerned. So if we look at SPY, we can see there was the last correction that we had from late April to all of May, basically. And then we had the breakout there in June. We had the higher high there about a week later or less than a week later. And then it was just these little pullbacks along the way. 1, 2, 3, 4 little pullbacks, and each one resulted in a breakout and a higher high. So we're kind of just stair-stepping up after that initial thrust from the early part of June. You got a very sharp move, and now we're kind of zigzagging higher. So that tells you momentum is slowing, but that's not a bad thing because upside momentum is still clearly stronger than downside momentum. If you look at the indicator window, you can see that RSI had that double dip below 30, and then it broke out. And that was a good signal as well to confirm the wedge breakout. And RSI has not been below 50. It touched that 50-ish area in late June, late July. But as long as it remains above 50, I don't think we have a correction upon us. If you look back at March, you had that move below 50. We did move to new highs, but we moved back below 50. So that was kind of a corrective period. And then you look in May when we broke below 50 and we had a pretty extended correction. So that's maybe the first level to watch for a sign of a correction. Is it a bearish signal that is playable? No, I don't think so, for the simple reason that we're in a bull market. All right, the S&P 500 just hit a new all-time high. Technology hit a new all-time high. QQQ hit a new all-time high. So why fight it? All right, I think it's better to wait for a pullback and view that as an opportunity. So if we look at pullback opportunities, we can see that the 50-day is coming in there around 291.5. You have the lows here, kind of that support zone in the 290, 292 area. I could add some Fibonacci retracements here, but I'm still getting ahead of myself here because we haven't even got any kind of a breakdown to base a pullback. So there's that 38% retracement around 91. And you can see, of course, we're overdue, but, just because we're overdue doesn't mean we're going to get it. We've had about a 10% advance in 8 weeks. And if you want to count the days since this advance, you can use the cycle lines tool. So I'll go over on the left here and I select cycle lines and I will start at the low there and I will draw out. And if you look at the bottom right, you'll see 39 days. So this move is 39 days old. It's gone around 10%. So that's 10% in 8 weeks. So you don't need an indicator to tell you you're a bit extended and perhaps right for a pullback. But again, as I said, right for a pullback doesn't guarantee it because you're fighting the trend. All right, so it's best to wait for that pullback and use it as an opportunity rather than say, oh my God, this is the big one, we're going down, this is a bear market. Let's cross that bridge when and if it gets here with the state of the market that you get on Thursdays as a video and Fridays as a written report. So here's QQQ, and of course QQ got the breakout as well in early June. The 10-day rate of change moved above 0, and it has been above 0 since that early June move. So we have not had a 10-day stretch for QQQ when the rate of change was negative since the early part of June. So that tells you that, 10-day holds have been positive. And since then, of course, we've had these little consolidation pullbacks along the way, and we keep moving to new highs. Now, the big news last week was, of course, the breakout in small caps and mid caps. Now, you can see overall they've gone nowhere. All right, I put the Fibonacci retracements tool on here, and it extends from the low in June to the high in May, or should I say the May high and the June low. And there's the 50% line. So that's the midpoint of the range over the last 6 months. So we're currently above the midpoint of that range. So the cup is half full, if you will. We've had a pretty sharp advance. We've had a falling wedge, and we've got a breakout. All right, since the breakout, we've had a big down day, big up day, a less big down day, but the breakout is holding. So I see that 155 area as kind of the level to watch. As long as it holds, this is a bullish breakout for small caps. But if we move back below 155, I think we need to reassess this breakout. We're kind of moving back towards neutral at best, because look at this trading range that IWM has been in for 6 months. It's gone nowhere. And if you look at MDY mid caps, we have a similar wedge flag breakout. There's no real difference between a falling wedge and a falling flag. They're both corrective patterns. A falling wedge is sometimes a longer term pattern. A flag is sometimes a shorter term pattern. But what happens is, here's that sharp advance in January and into February. And then we had the falling wedge there and the breakout. We had another sharp surge in March, April. And it looks like a bull flag was taking shape, but we broke down instead. And that led to a pretty deep correction. So now we've got this surge and this wedge and the breakout. And the breakout is holding. And as long as we hold above 355, I think it's a valid bullish breakout. But if we break below 355, I would reassess. Now, as noted last week, because I talked about IWM and regional banks and banks, I Googled IWM ETF holdings, and there's the iShares link there, and that is the fund family website. If you want to know the most up-to-date holdings, I think that is the best place to go. And then if you scroll down, there you can see links, and there's a link for the portfolio. And if you look at the exposure breakdown there, you can see that financials got a little cutoff there, but financials are 17.9% of IWM. Healthcare is 17%, industrial 16%, and information technology is the fourth biggest sector. And that's not the case with the S&P 500, where information technology is the biggest sector at around 22%. But what this means is financials are the ones to watch when it comes to small caps. Also throw in healthcare and industrials. They're like the three amigos there, the troika. And you got to watch those three. And healthcare has been really hit and miss. I'm going to get into the healthcare sector a little bit later here. So last Tuesday, I talked about the banks, and I showed IWM and MDY with the Bollinger Band squeeze, and also the Aruns were at low levels. They were falling in parallel fashion. There you can see that now. You can see last week the Aruns were below 50 and falling in that parallel manner. So that told you there was a consolidation. Bandwidth was right. It was below that 5% level in early July. So you had a bit of a squeeze, and then you had this breakout there, and we had a pullback, and we had another move higher. So, if you look at KBE, it's still a laggard because it's below, not only is it below that February high, but it's also below the April high. So it's been kind of consolidating here. And the swing within that consolidation is up, and I'm marking support there at 42. I can extend that. So if we break below that level, that's going to be a negative. I don't want to get cute and mark support, at this low here or at this falling 200-day. But I think it's important to watch banks as far as the health of small caps are concerned. And right now they're looking positive. We'll see how long that lasts. And the Fed, of course, is meeting this week. Here's the regional bank SPDR, and this is even more in tune with small caps because regional banks tend to be smaller. KBE has some of the bigger banks. And you can see this one has just been consolidating. It's one big triangle. Now, it is a triangle after a big advance. So it could be just one long consolidation. The swing within that consolidation is up here. And so we're on the verge of a triangle line breakout. So I think the cup is half full. You close below 52, then the cup becomes half empty. And then you have a problem for small caps, I think. So I want to take a look at the railroad group because I'm seeing some strength in selective railroad stocks. And I do mean the actual railroads, like Kansas City Southern and Union Pacific and Norfolk Southern. You do have related industry groups that make whatever rail cars or things to support the railroad industry. But if you look at this 3-month rate of change ranking here, you can see Trinity is not doing so good. Wabtec is not doing so good. Greenbrier and Freight Car America are not doing so good. They're listed in the industry group commercial vehicles, but they really, I think, supply the railroad group. I think Wabtec is also involved in autos. But if you look at the performance for the rails, the Canadian rails are doing good over the last 3 months. There's Canadian Pacific and Canadian National Rail. And if I move this out to 1 month and I get an automatic update there, and I'll just do a refresh to make sure, we can see Union Pacific is the best performer over the past month, and Kansas City Southern is one of the better performers. And those stocks are breaking out to new highs. And I'll look at Canadian National and Canadian Pacific as well. So as you can see, I've created a chart list with the stocks that you see here, these railroad-related stocks. I like to keep very niche groups together to see how they're performing as a group. And once you have them in a chart list, you can do a lot of different things. So this, I got the View As there link at the top right. And so I click View As. I can do 10 per page. I can do a chart book. I can put them in an RRG to show relative strength or weakness, market carpet, correlation. So Candle Glance is one of my favorites. I'm going to go ahead and choose that one, and I'll get a new page. And there you can see I've got all these small charts, and right away I can separate the contenders from the pretenders. Which one have strong charts with potential breakouts in the making, and which ones are weak. And if you look down at the bottom there you can see the weak group stocks there. Greenbrier is in a downtrend. Rail Car Freight of America is in a downtrend. Trinity is in a downtrend. And Wabtec is flat at best. So I would be concentrating on the actual railroad stocks and not the ones that are supporting them. Now, I will be perfectly honest. I do not know anything about the individual fundamentals of these companies. I do not know which one has higher sales, which one has higher earnings, blah, blah, blah. I think most of what we need to know is on the chart. But I would think that the rails like CSX and Kansas City Southern and Norfolk Southern and Union Pacific have pretty similar business models. Maybe some are more regional than others, and maybe some regions of the U.S. are performing better than other regions. That might be affecting them. If you look at CSX, it's one of the weaker of the group. But if the group, if I see Union Pacific, as you'll see in a minute, and Kansas City Southern breaking out, there might be opportunity after this big sell-off in Union Pacific. As you can see, we're coming into that 50 to 62% retracement zone. We're coming into, there's kind of a resistance level that was broken. It might turn into a little bit of a support zone. You've had a very serious decline and washout, and now we're firming. And at the very least, we could get an oversold bounce here in CSX. Now, the real leaders, though, here, look at Kansas City Southern. All right, this is a bullish chart. If you look here, you can see, I'll go ahead and put some annotations on there. There's the high, and you can see got to new highs. We had this kind of a pullback that formed a triangle of sorts. It's kind of a sloppy triangle or sloppy, flag, if you will. But we did break out there. We had a throwback into the breakout zone, and then we're pushing up to new highs. So this one still looks like an uptrend and a strong stock. If you look at Norfolk Southern, it took a hit, but not as big of a hit as CSX. But still, I think it's in a longer-term uptrend. It's above the rising 200-day. And you can see there's a resistance zone right there that turns into a support zone. And you can throw in that little consolidation here and this high, and you got a big support zone coming into play. I don't think the 200-day is support or resistance really, but when you're above it, the cup is half full, you're in a long-term uptrend. When you're below it, the cup is half empty. It's as simple as that. So we've kind of corrected. We've got this gap down, but you can see we're getting a bounce, and we're working to fill that gap, and that's kind of the first thing to watch to see if we fill that gap, and that could be a meaning that we're going to move higher for Norfolk Southern. So this is one I'd keep on my radar as well. And then a leader here, Union Pacific. No doubt about it. All right, if you look at this chart here, there you can see there is the move above the prior high there. So it was hitting a new high in February. And then you had this little pullback, kind of like a flag. And then you had a longer channel wedge, if you will. And look at that. We broke out, had the gap down after earnings, and we're right back up. How's that for strength? All right, so this might not be the most exciting stock in the world, but it is in the midst of it's got an active breakout working. And so I would expect it to continue higher because of the uptrend and the active breakout. And I think it's showing market leadership. And for Greg Schnell and all of our Canadian friends, I'll go ahead and cover two Canadian rails, which are doing well as well. There you can see that breakout to new highs. Some people might say, oh my God, it's a failed breakout. We broke support here. Come on, you got to keep it in perspective. All right, you had this monster advance from late December to April. You're entitled to a pullback. Don't get your knickers in a twist over a little short-term support break like that. And then we rallied to new highs. So this one is still doing okay. I think it's got a big support zone there in that 88 area. Here is Canadian Pacific, and Canadian Pacific is doing well. It has a move to new highs there, kind of a consolidation and a breakout. So there's a potential support zone to watch. If you get into that 230 area, that might give way to a bounce. All right, now I want to review healthcare, and XLV, which is the sector SPDR, it's the healthcare stocks that are in the S&P 500, is at an interesting juncture. And when a stock ETF is at an interesting juncture, that means I'm looking for a potential reversal. And why is it interesting? Well, first of all, you can see that you have that big triangle pattern, big consolidation forming for most of 2019. From the latter part of December all the way until May. And then we got that breakout. And that's a bullish signal there. And so since we've gotten the breakout, we've kind of consolidated, moved up and down. But the breakout is largely holding. It's kind of that 90, 91 area. So we had a little bit of a pullback, and we've come to that 50%, 38 to 50% area. There's the breakout zone. And when you get a surge and a pullback to the breakout zone, there's the surge, there's the pullback. That's called a throwback. All right, a throwback sometimes gives you a second chance to partake in that breakout. In other words, at 94, you're like, oh my God, the breakout, I missed it. It's too late. But now you're coming back into that 91, 92 area. and you're starting to turn up, that might be the second chance. And I got a little resistance level there at 93. So watch for a breakout there and watch for the PPO to turn up as well. Now, if you look within the sector, and I like to do this with my ETFs when I can. You can do this with healthcare and technology especially. But I've got all the healthcare related ETFs together. So I can see a breakdown of the sector with tradable ETFs. And I prefer ETFs over industry groups because I can go to the ETF website and I can see the holdings and the weightings, and I can see the main drivers of that ETF very easily. Try to do that with an industry group. I find it very hard, especially those Dow Jones industry groups. I can't figure out what the weightings are in those anywhere. So if you look at IBB, which is the biotech ETF, and it is weighted towards the large cap biotechs, it hasn't performed well this year. All right, since September, it's got a lower high there into February, and it's got further lower highs in 2019. Now, it is above the December low, so maybe this is a massive triangle, I don't know. But what I saw is we got this breakout, and now we've got a throwback to the breakout zone, and we're firming. So this is an interesting area to watch, and I'm watching for a breakout at 107, and that would help healthcare a lot. As you can see, there's some big biotechs in this. Now, if you look at the equal weight biotech ETF, XBI, it's holding up better, I think. And you can see there's the pullback and the falling wedge. You hit the reversal alert zone and you broke out. And now we've come back to the breakout zone with a falling wedge, and we're at support and we're firming. And if we get a breakout there, I think that's going to be bullish for biotechs, and that would help healthcare. So there's 3 levels to watch here for healthcare and biotechs, and that could be the key to the healthcare sector. If we look further within, there's healthcare providers. I don't have a good read on this chart. Not a clear signal. You have this pullback after the gap surge, but I'd pass on it. The clear leader, healthcare devices, unequivocally the leader there. You can see that triangle consolidation and then the breakout in May and the move to new highs. So this has been the strongest industry group within healthcare. Now, if you look at the top holdings for XLV, you can see that it's still the big pharmas that are dominating the XLV as far as the weightings. Johnson & Johnson comes in at 10%, Pfizer at 7%, Merck at 6%, Abbott at 4.5%. Medtronic is medical devices, and then you got United Health Group at 7%. But I want to look at these top 4 holdings to show you why that sector is a bit of a mess as a whole. So I'm going to look at the top 4 stocks in the healthcare SPDR, and the first one is Johnson & Johnson, and 3 of these 4 have really trading ranges. They don't have easily defined uptrends, and one has a clear uptrend. If you look at Johnson & Johnson, it's been moving above and below that 134 area since September. All right, it's got a downswing, an upswing. This latest downswing looks bearish, but you can see we're coming into a potential support zone and getting a bounce. So maybe there's a mean reversion bounce working for Johnson & Johnson within a trading range. Now I'm going to skip Merck and come back to it. But if you look at Pfizer, it too has been locked in this big trading range here since September and gone virtually nowhere, above and below that 42 area. And then you look at United Health. All right, it has gone nowhere in this period from September, where you can see it did hit a new high in November, but then it got hit hard, started zigzagging lower, got a big bounce, but it's still really flat over the past 9 months. And that leaves Merck as the one that stands out among the big 4 here, if you will. I mean, this one has a clear uptrend working here. Look at that. It's just zigzagging higher. It's the only one that has a clear uptrend. You can see we had some, pullbacks along the way. There was a consolidation. There was a very sharp pullback, but we always moved to new highs. So I think if you're looking for the strongest healthcare stock among the biggies, the big four there, Merck is the standout here. So the first stock is Docusign, and it's an IPO. You can see that there's when the 200-day moving average starts, and that's when it was trading 200 days. So that's when you have enough for that 200-day moving average. You can see that we had a breakout there with the big move in January. And then since then, we've had what looks like a long consolidation period there. And you can see there's a downward sloping trend line. I'll just elect to draw through this gap down and surge because I think overall the essence of the pattern is a correction, and there you can see a resistance level. So if you get a breakout there, that's going to be bullish for Docusign. Next up is Keysight Technologies, and this is going to be a more volatile stock, but what I see is a potential cup with handle, which is a bullish continuation pattern. So there you can see rim resistance. There is the cup. There is the handle. And if you look at the right side of the handle, you can see that there is a falling flag. And we got the breakout working and a little throwback. So I still think this one is bullish, but volatile. Also check earnings. I don't think any of these report in the next week or two. I try to pick stocks that have at least 3 weeks before they report earnings, so we have time to get a buffer on the trade. Here is Mccormick, and Mccormick is one of the stronger stocks. There you can see breaking to new highs there. And again, there's that instance where if you're too short term, you can say, oh my God, this is a failed breakout. Well, it's entitled to a pullback or a little bit of volatility. But I think the important thing is there you have this little surge and this pennant, and we're breaking out of that. And I think that is a bullish development. Next up is NAPCO Security Technologies. This is going to be a more volatile one. But there you can see a resistance breakout. And then we have kind of a support level, another breakout, and a support. So we had a pretty sharp decline, but we're coming into a lot of support and we're breaking out again. We're bouncing off this zone here. So that looks like a bullish development for NAPCO Securities. Again, a volatile, risky stock. And finally, PACCAR, PCAR, has a bullish pattern. There is the new high. There's a pullback after the new high and a breakout. And yeah, there's a lot of, consolidation and mess here in this area. But I think overall it's a consolidation within an uptrend. And I would expect the uptrend to continue because I am a trend follower type of guy. And that concludes this edition of On Trend. Thanks very much for tuning in and have a great day.